Hi and welcome to Trading with Tani. In this video, I'm going to show you the best way to trade. Trust me, I'm not going to tell you to buy or sell whenever the market crosses the moving average like this. I'm going to show you the best way to identify high probability trades like this and be able to make money in the market using moving averages. So now let me show you the best two ways to trade moving average. The first one is using moving averages to identify the trend. So if you look at this market here, you're going to see that when the market is going in an upside direction, the moving average is also going to be also sloping, going to the upside direction, as you can see here, because the market keeps going up and going up because you are using the closing price of these candles. So if the closing price of these candles continue going higher and higher and higher to the higher price, that simply means the moving average is gonna follow and is gonna be below the prices. So this is a 50 period moving average if you ask, and for you to find the best moving average for you, I'm going to show you in a minute. So here you can see if the market is in an uptrend, the moving average is gonna be below the market, or the market is gonna be above the 50 period moving average. In this case here, you can see that when the market was moving in a downside direction, the moving average was above, and then when the market goes to the upside direction, the market was in an uptrend, and also the market goes below the moving average, the market is in a downtrend. So if you are trading and if you don't know how to read the trends correctly, the moving average can be the simplest way of you getting to know the trend, right? Now, knowing this doesn't mean that, okay, always when the market is below the moving average, you have to sell. No, what you want to do is you want to use this moving average to filter strong trends and long-term trends. And the way that you do this is plotting multiple moving averages on your charts, right? And you are going to see that the shorter the moving average period, then the shorter the trend, or the more momentum the trend have. Like if you look at this candle here, you're going to see, if you look at this chart here, you're going to see that I have three moving averages here. The black one is the 200 period moving average, which is right here. This is the 200 period moving average, and this is the 50 period moving average, and then this is the 21 period moving average. And the way that these three moving average works is that if the market is above the 21 period moving average, right, we know that we are in an uptrend. But if you look at this, you're going to see that the market goes all the way up and then it goes below the moving average right here, which means this short-term trend is almost over here. In this case, it continued higher, but here also it broke this moving average, showing you that this trend here, which was very strong, have now ended, and we are likely now going to the downside, which didn't continue, but it shows you already that the trend is losing momentum. You can see here the market also shows you that the market is now going below the 21 period moving average, so the market is losing momentum. So here you are going to be using the short-term trends of the market. But if you go to the higher moving averages, like the 50 period moving average here, you can see that from this point here to this point here, we're still in a long-term trend because we are above the 50 period moving average, which is in red right here. And also for the 200 period moving average, you can see that from this point all the way up to this point, we are still in a very long-term trend because we are now using the 200 period moving average. So this is the three moving averages that are most commonly used. If you want to just capture short-term trends, you can use the 21 period moving average and say if the market is above the 21 period, I'm in an uptrend, in a short-term trend, right? But you are going to see that this moving average is going to be crossed at the market many different times, right? But you are identifying short-term trends. Also, if you want to identify long-term trends, you can identify them using the 200 period moving average, right? Now you can see that sometimes the market is going to be below the 21 period moving average, right? 21 period moving average here, you can see then the market crosses here, showing you that this short-term trend have ended, and now it goes down again, showing you again that this short-term trend have ended. But if we were using the 200 period moving average, as I showed you here, from this point here to this point, you can just see that, okay, this was a long-term trend, right? So for example, what I'm talking about here is, let's say you were selling maybe at this point after this crossover, for some reason, let's say you were selling with this long-term trend, you could have gotten all the market until it goes all the way down here. But if you were looking at the short-term trend, you could have exited the market right here when the market started going to go to the upside, right? So basically what I'm talking about here is the moving average can just show you the direction of the market and how strong that trend is still going in one direction. Now let me give you two best ways of trading these moving averages, right? So the first one here is using the moving average for multi-time frame analysis. I'm gonna give you a very good example. This is a 21 period moving average, and as you can see, the market is above the 21 period moving average, so we are looking to buy because we are in an uptrend, right? But we cannot just buy here before having enough confirmation. So we can use the 21 period moving average to get the confirmation of what the market is doing, right? So here the market is going to the upside, so we want to be buying in a long-term trend, but we don't buy here. We go down to the lower time frame to look for another opportunities, right? So for example, if we go to the lower time frame of this is now the M15 time frame. If you look at this here, we are no longer using the moving average. We already used the moving average to identify the trend, but now we are looking at major levels of structure like this. You can see that this market is moving up, and then before we buy, right? So if we were trading the 15-minute time frame only, we were probably looking to buy here. But also now that we are combining the 1 hour time frame and using the moving average to identify the trend of the 1 hour time frame, we can see that we have enough confirmation to have confidence to buy at this point. Why? Because we are in a major level of structure, and previously we saw that this market was above the 21 period moving average. So when you go to the lower time frame and have another confluences or confirmations, we have enough confidence to go long here, because in a long term the market is in an uptrend. Now here's another example. So you can see that this is 1 hour time frame. This market has been moving in a downtrend for a long time, and now at this point this market have jumped above and now started to trade above the 21 period moving average. Here you can see the market breaks here, makes a pullback, and now is trading above the 21 period moving average. So we are thinking that this market should continue going to the upside. But before we do that, we know now that the market is above the 21 period in a bigger time frame. So if you go to the lower time frame and look at the 5-minute time frame, we want confirmations. In this case, you are going to see that this market, the confirmation we have here is that this market was moving up, it makes a pullback, it moves up again, and then it's now reversing back into this zone, which was previously a level of structure. If you want to learn more and the full tutorial of how to use this break and retest strategy, I'll leave a video in the description of this one, so that you can go ahead and watch how to trade this strategy, which is called the break and retest strategy. In this case, you can see that the market now pulls back into this zone, and we are likely to go to the upside. But we can only know this after we confirm that our higher time frame is above the moving average, which means is in an uptrend, or the uptrend is just starting out. So in this case, you can see the market went on and go to the upside after this. So that's how you trade moving average. First of all, be able to identify the trend, and then you can use this in multi-time frame analysis to make money, right? Now, the second way of using moving average is to use moving average as areas of value, right? If I show you this chart right here as an example, you are going to see that this is a 21 period moving average, and this market here, which is volatility 10 index on 5-minute time frame, if you look at it, you are going to see that most of the time when the market comes into this moving average, it likely bounces on this moving average for some reasons, and I don't know what are those reasons, but you are going to see that this market is bouncing more on this moving average. So when you are trading this market, and next time when you are looking at this market, you can see that we can say that, okay, if this market is bouncing more on this, what are the other confluences that I can combine with this so that I can be able to get these high probability trades? For example, if you look at this, you are going to see that the market pushed here below moving average. Once it pushed below the moving average, we see a reversal here, a break again, and now another retest. This retest is coming into the moving average, and if this market has been reacting into this moving average, then chances are the market will likely drop to the downside. So this would be a good position for you to sell, right? So as simple as that, you can look at another example here. The market again pushed down, and then now it reverses back into the moving average. Also, this moving average being an area of value, you can see here market pushed down, a reversal, break, and then now retest. Now instead of just relying on this zone as your break and retest, you can also rely on the moving average and say, okay, if this market is retesting into this zone, and also this zone being at a 21 period moving average, which is looking like an area of value here, you could sell again here, put your stop loss here, and you take profit down below, right? And now here's another example. You can see the same thing happens over and over again. There is a retest, and then the market is retesting into this zone, and this zone also happens to be in the moving average. So for example here, you can see again the market makes a big move up, it reverses, moves up again back into this zone, and this zone happens to be on the moving average, which is acting as an area of value for our trade right here. So these are the two of the easiest way of trading moving average. Number one, just use it to identify your long-term trends, short-term trends, and your strong trends that you can use. Then move back to lower time frames to find your entries, or you can use it as an area of value. If the market is reversing into a moving average, just look back into the left and see if the market, if that moving average is aligning with another strong level of structure. Then you can enter into high probability trades, and you're going to make money in the market. So if you want a full tutorial on how to trade forex as a beginner, I have a complete beginner's guide or a complete trading course which is completely free. I'm going to leave the link in the description, so check out the link and you are going to get a free trading course that is going to teach you from what is forex, how do you get started, how do you join the market, how do you analyze, and how do you place high probability trades. It is completely free. Check out that course in the description below, and I will see you in the next video.